Oil giant BP has issued a profit warning, so what's gone wrong? BP has warned investors this morning that its profits will fall by up to $300 million in the fourth quarter. It blames lower oil production and weak refining margins. Janet Moy follows that stock at RBC Brewin Dolphin. Janet, what's been the problem for BP?
I think a main issue for investors is that it is waiting for a more strategic update from the new CEO. But unfortunately, that is being delayed because of his health issues. BP has suffered problems, and its share price performances have lagged its peers, mainly because of its previous strategy of focusing more on renewables transition. But obviously, the new CEO is planning to reverse that and refocus more on traditional oil and gas. But investors are just waiting to hear more. So unless there is a very credible, profitable plan that is not going to put other issues like share buybacks at risk, I think we just have to wait and see. And the other problem is, as you mentioned, is really the refining margins that is being squeezed, and lower oil production and maintenance problem that is all going to cost money. But there are also industry-specific problems as well, which is oil prices have been low and demand has been weak from China's economic slowdown. But towards the end of the year, we have seen a bit of pickup in the oil prices, which may help. But as I said, it's mainly about the turnaround plan by the new CEO.
But there is, as you say, a broader problem in the industry with oil demand. Shell and Exxon both warned of weakness last week. Do you see oil prices recovering this year?
It is hard to say. I think, as I said, there has been a bit of a pickup recently because of US having more sanctions on the Russian oil and gas sector. But I think overall speaking, oil price is really a tug of war between the demand from China, which is slowing. There could be a bit of upside if China pursues more stimulus measures. And the tug of war is between the demand from China and also the supply constraints stemming from geopolitical concerns. Although generally speaking, we're not very worried about a spike in the oil prices, because at the end of the day, the US is now the largest oil producer and exporter. So the extra US oil supply is going to reduce the world's reliance on OPEC anyway.
You mentioned that BP in particular has scaled back its plans for the energy transition. It abandoned a target to cut its oil and gas output by 2030. Are we going to see more of this, do you think, from oil giants as their fossil fuel margins come under pressure?
Yeah, I guess, given that BP has been a very prominent supporter of the transition to renewables, I guess the theme is that major oil producers see that refocusing back on traditional oil and gas is going to attract more investors' attention, and that is basically what the market wants them to do. So I suspect that this trend could continue. Both can be done alongside, but it's a matter of how much focus you put in each of the area. But it's clear that the oil majors are shifting more back to the traditional oil and gas.
Looking at the wider market today, Janet, government bond yields in the UK and Europe seem to be taking a breather after the recent sell-off. Why is that, do you think?
Today we had UK 30-year index-linked gilt sales, which is oversubscribed by 3 times, which I think still indicates solid demand for UK government bonds. And in general, what we think is that yields have risen very sharply. Obviously, it's not a UK-specific problem, but also a lot of that is attributable to investors' concern on growth and the budget deficit and debt sustainability. But we feel that actually the current yields are pretty attractive. The thing is, given the moves in the bond yields, we think that the bond vigilantes are back for the UK, and that is somewhat actually a mechanism to make sure that the government would be doing the right thing for the fiscal side of things. So we're not too worried about further drastic rise in gilt yields, for example. So I guess maybe for a lot of investors, it is really starting to be attractive in terms of yields. So that's why we're seeing pretty solid demand there.
Janet Moy of RBC Brewin Dolphin. Don't forget, you can watch more videos on Reuters.com.